Hey Bowtie Nation, Joseph Hogue here, talking about the single most important question in investing, and the answer isn't what most investors think. In this video, I'll walk you through the differences in stocks versus bonds and why you need both in your portfolio. Then I'll reveal how much to invest at every age. And that is not exaggerating to say that this could be one of the most important videos you watch about investing. In fact, one study found that 93% of the changes in your returns are due to what I'm going to show you today. Now, some of this first material might be more basic than many of you need, so I'm going to include a clickable index in the video description below. Please, though, watch through this video because answering this question, how much to invest in stocks versus bonds, could save your money. We'll start off with the basics of stocks versus bonds, what each are, and their roles in investing. Stocks are an actual partial legal ownership of a company. With that share of stock, you have a right to all the future earnings distributed while you own that. Of course, the potential for those higher returns also comes with the risk that there won't be any future earnings. Bonds, on the other hand, are a loan to the company, usually with fixed interest paid twice a year. If a company needs funding but it doesn't want to sell more of its shares, it can then borrow or sell these bonds and will only have to pay that interest each year. In a set number of years, all the way up from 30 years to even 99-year bonds in some cases, the debt is due and the company pays back that loan. So then as an investor, you get that interest payment twice a year and then your portion of the loan paid back at maturity. Obviously, this is much lower risk because it's a contractual loan, but also tends to be lower return than stocks. There are pros and cons to both stocks and bonds here, and in fact, the pros of one usually balance out the cons of the other, making these perfect complement investments. The advantage in stocks is that potential higher return. Shares of Tesla are up almost 1,200% over the last 5 years. On the downside, of course, stocks can be extremely volatile. Those same shares of Tesla have fallen 40 and 50% over a matter of months, several times in that same period. Now, if you've been able to hold on to your shares through all that, no problem. Your investment has always rebounded, but some investors have lost a tremendous amount of money, whether panicking and selling when the stock dropped, or just needing that money and having to sell at the wrong time. Bonds, on the other hand, give you that cash flow and the safety that you don't get with stocks. Defaults, or bonds that don't get repaid, are extremely low for high-quality companies. Less than 2 bonds out of 100 go unpaid. And while everyone argues about the value of Tesla shares, how much they should be worth, bond values don't really change that much because they're based on those set payments. You know exactly how much you're going to get in interest and at the end of that bond. The pros of bond investing also include protecting a part of your portfolio from that stock crash so you can take advantage of the lower stock prices when they come along. If you think stocks are expensive, you hold some money in bonds and protect it until stocks are a better value, and you're going to earn that higher interest rate than you'd get with savings. Next, I'll show you how to invest in each and exactly how much at each age. But first, I want to personally invite you to get the Weekly Bowtie, our free weekly newsletter with all the stock market news, strategies, and trends you need to know. Each week before the market opens, I'll show you what I'm watching and the stocks that could highlight the week. It's all totally free, just something I like to do for all you out there in the community, so look for that sign up link below. Now let's look at how to invest in stocks and bonds and a couple of strategies in each. Buying stocks is surprisingly easy. You can invest in individual stocks like shares of Tesla or Apple, or you can buy exchange-traded funds, ETFs, which are just groups of stock sold as a single investment. The best strategy for investing in stocks, and this is something all you out there in the Bowtie Nation hear me recommend constantly, is called the core satellite approach. This is where you invest most of your money in those broad ETFs, these funds that hold lots of stocks in a theme like dividend payers or tech stocks. Invest maybe 50 or even 60% of your money in just a few funds gives you those broad exposure to thousands of stocks with the click of a button. Then, with the rest of your money, you buy maybe 10 or 15 individual stocks. Now, what this does is that money in the funds is a super simple investment. Since the funds are spread out across hundreds or thousands of stocks, you'll never have to worry about one company or whether you paid a good price. You'll get a consistent return on all the stocks in that fund. But then with a handful of individual stocks, you get that chance for the higher return. That chance to pick the next Tesla or the Apple and let it take your portfolio higher. Since it's only 10 or 15 stocks, you don't have to spend hours analyzing and picking the right stocks. You just invest in a small group of the best stocks you can find. Now, investing in bonds here is even simpler. You can buy individual bonds through an online broker, but for the vast majority of investors, it's just best to buy those bonds through an exchange-traded fund that are going to hold hundreds or thousands of these investments. That's because the fees to buy individual bonds can be much higher than stocks. Commissions can range from 1 to 5% on the market price of a bond, and you'll need dozens of bonds to give yourself that kind of diversification that you'll get with just one ETF. By comparison, most bond funds charge less than 0.25% a year to hold that fund, so just $2.50 for every $1,000 invested. For example, this Vanguard Long-Term Bond ETF, ticker BLV, holds over 2,600 bonds in high-quality companies. It pays a 3.9% dividend yield and charges just 0.04%, which means you pay just 40 cents in fees for every $1,000 invested. Another example here is the iShares High Yield Corporate Bond Fund, ticker HYG, which also holds thousands of individual bonds and pays a 5.6% dividend. So now that you got a good idea of those basics in stocks and bonds, I want to throw this out to the community. Which do you feel is a better investment for your situation? What serves your personal needs best? So scroll down and let me know in the comments. Now for the most important part of the video, how much to invest in stocks and bonds. And this isn't an either or situation. The answer is much more about finding that perfect mix of stocks and bonds that gives you the return you need, but with less risk so you can sleep at night. And here, understanding how much to invest in stocks versus bonds is about understanding how much risk you can tolerate without stressing yourself out. And most investors don't realize that this answer is going to change as you get older. For example, younger investors have decades to watch their money grow, so a single market crash isn't going to mean as much over 30 years of investing. They can take that risk with more stocks and reach for that higher return. By comparison, investors nearing retirement, safety and preservation of your money is going to be the most important idea. Is it worth maybe another 15% return on your portfolio if you have that 50-50 chance of just getting wiped out in the next crash just before you start needing that money to pay the bills? Of course not. So you'd want to have more money in bonds to protect your portfolio. So let's look through some of the guidelines for each decade and recommendations for how much to invest in stocks versus bonds. So here, for investors in their 20s, you're probably just starting to invest. You've got decades ahead of you and maybe not that much invested anyway, so a drop in stocks wouldn't amount to that much anyway. You're not going to need that money for a very long time, so you don't need that protection in bonds. So here, you might have as much as 80% of your money in stocks and just 20% or even less in bonds. That's going to save some money aside just in case stocks tumble, so you can sell your bonds at that point and use the cash to get into those stocks at a discount. Now, the video is stocks versus bonds, but in reality, it's better to break this out into other assets as well, like real estate and commodities. So here, instead of just stocks and bonds, you might have 65% of your money in stocks, 10% in bonds, 15% in real estate, and maybe another 10% in alternative investments. That's going to give you those strong returns in stocks and the alternative investments, along with the cash flow in real estate and bonds. And I can already see some of those eyes rolling out there. Some of you young guns that don't think you need anything in bonds. Trust me, everyone always needs something in bonds, at least 10% of your money to protect you from that what-if scenario where stocks crash or you just suddenly need the cash. As you age into your 30s, your portfolio probably isn't going to look a lot different, but it's those little shifts that happen over decades that are going to make the difference here. You still have 20 years or more before needing that retirement money, so you're still having something like 75% of your portfolio in stocks and maybe 25% in bonds. Or bringing in those other assets. Maybe you have 60% in stocks, 10% in bonds, 20% in real estate, and then that 10% in alternative assets. So you see here, you've taken a little risk off the table by shifting that 5% from stocks into real estate. In your 40s, you're getting closer to needing some of that money for college expenses, or maybe you just finally want to take that dream vacation. You're still more than a decade out from retirement though, so you want more money in stocks still to give you that return you need to keep growing your money. So here you might consider holding that college money in a separate account and having more of it in bonds for that safety, but generally you're still going to want as much as 65 or 70% in stocks, the rest here in bonds. Using our other assets in the mix, that might look like 55% in stocks, 15% in bonds, 20% in real estate, and then 10% in those alternatives. And again, the important part here is just notice that we're gradually reducing our risk and shifting more to safety each decade. This can be an extremely easy investing strategy, just making these small changes every 5 or 10 years to make sure your portfolio is aligned with your age. In your 50s is where you're going to see those bigger changes, whether you're planning on retiring early or not. You're about a decade out, so you can't afford to see it all wiped out with a stock crash. That's why we'd have more like 60% in stocks and 40% in bonds here, or something like 50% in stocks, 15% in bonds, 25% in real estate, and 10% in alternative assets. Now in your 60s, you'll make that final little tweak before retirement, and this is when you need the most protection. Folks, it is heartbreaking that in a recession, when stocks crash, I always hear dozens of stories about someone in their 60s just months before retiring when the market crashes, and they end up having to work years longer than expected. So this is when you really need that protection you get in bonds, maybe even as much as half of your portfolio, so a 50-50 mix of stocks and bonds. Or with your other assets, you might even have less than half in stocks, with 40% in stocks, 25% in bonds, 25% in real estate, and 10% in those alternatives. And then in retirement, this is the big payoff, right? While max safety is going to be your goal here, you still need your portfolio to grow a little so it keeps up with inflation and keeps paying those bills. This is 30 or 40 years of your life, and prices can double in that amount of time. So that is going to mean that you always want some of your money in stocks for that higher return, but you need enough in bonds and cash flow investments to cover those bills, so you don't have to sell your stocks at exactly the wrong time. Here you might consider as much as 30% of your money in stocks, with 70% in bonds, or something like a mix of 30% stocks, 40% in bonds, 25% in real estate, and then just 5% or less in those alternative investments. Get your Bowtie Weekly free with the link below, or click on the video to the right for the 7 monthly dividend stocks that will pay your mortgage. 7 stocks to put a roof over your head. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.